Well, g'day there, everybody. Thanks a lot for joining me on this Thursday afternoon market recap. We did see today, collectively, the US markets pull on back and really give back some of those earlier gains that we had established in the week. I'm not really all that concerned about this. This is generally what we consider that of market noise. But it does, of course, open up the question still, whether or not we are going to see that definitive push up to that 26 area prior to this gap closing. You can see more or less we are at the midpoint way of this bull flag breakout. We've seen a very nice rally up until really Wednesday's session worth of trade today, again pulling on back down. But it's sort of sitting here in no man's land. Generally, when you are in no man's land, you just leave the open positions alone. The reason I say that is because outside of the actual candlestick reversal, one, we're still not at our target, and two, we are still trending. We're trending on the minor level. We're also trending on that of the intermediate level. Just to show you this, when I reference that of the intermediate level, I'm talking about this rising trendline support that I've mapped out here publicly on this YouTube channel over and over again, but also on the minor level, which is what we take into consideration with the exponential moving averages. You can see that price action on the Dow Jones Industrial Average, which has been historically the weakest of the three markets, is still holding up above its rising 10-day exponential moving average. So we're still yet to really even interact with that, even going back previously really to the midpoint of August. So considering this to be that of market noise, I am still personally holding my diamond positions. I'm still looking at this ultimately rallying back on up to about 26,500. You can just overshoot this 26,435. But what would be a really healthy thing, coincidentally, for the market would be to actually see this selling off a little bit further, to close this window, and then, of course, to see it stabilize and get that secondary push off from these rising exponential moving averages. So again, a lot of people tend to, become a little bit worried about the market when they do see a down day. However, it can be considered rather constructive and actually healthy for the market moving forward. Now, I've received a lot of emails really over the past, I'd say 48 hours in regards to the long weekend upcoming. I understand this coming Monday in the United States, the markets will be closed in observance of the Labor Day holiday. And because of that, a lot of people are asking the question, should I begin culling some of these open positions that are reflecting a pretty decent profit? And I wanted to address this in a public video because first of all, I wanted to point out that when you do get long weekends, right, you don't need to consider them, or at least put them or define them really with any real sort of link to that of an earnings date. All right, a lot of people become a little bit concerned around market volatility, right, with the long weekend, potentially some news events that may shift the market, aggressively against them potentially. That is what they are generally worried about and concerned about. However, you have to understand that the technical picture itself is still very much so bullish, and it's going to take a lot at the current juncture to really reverse the dynamic of what is a relatively strong upswing. So as a general rule, we never hold positions over earnings. The reason we don't hold positions over earnings is because we really can't quantify at all what the result is going to be post that report. However, when it comes to a long weekend, personally for me, it doesn't really change whatsoever my positions that are open leading into that longer weekend. Now, if you want to cull some positions or take some positions off the table because you are happy with what that profit has produced, of course you can do things like that. But just understand that at the same time, you are running the risk of actually selling prematurely. And the reason we have defined trading plans, i.e. our entry, our target, and our stop, is to keep us on track and really to sort of negate a lot of the emotional, or at least the emotions that flow into the world, or at least into your own world, through that of the markets. Okay, so that's why we have our entries, our targets, and our stops. And what I'm trying to say to you right now is that if you are a little bit concerned about the market, obviously it has been rather volatile, and I still expect it to continue to remain volatile. Well, then what you can do is, of course, adjust your stops, right? Make them tighter. If you choose to do that, it does, of course, raise the probability that if we do see a pullback into Friday's session, you will be stopped out. But the good news is that you will be stopped out for a profit. So it's really a decision, an autonomous decision that you need to make for yourself. There really isn't a right or wrong answer. It's more so, again, the blending of the art and the science of technical trading. But just because there is a long weekend, it doesn't necessarily mean that you need to, all right, overthink the situation and actually liquidate a bunch of positions. What would be the worst case scenario is that the market does pull on back down a little bit on Friday. You end up selling a bunch of trades, and then what you see next week is, again, that continuation off from what would become another bull flag setup, off from the rising exponential moving average, and then you miss out on the last little bit of profit up to, again, roughly 26,500. That's what I can definitely see as one of those two options. Otherwise, you're going to see a little bit of a deeper correction, right? Which is probably still going to set up in that bull flag type of scenario, very similar to what we saw last week, with the resulting push. Now, for me, when it comes to individual positions, and I've spoken about this both publicly and also privately in that pro class, what my personal sell trigger is going to be, essentially when it comes to a bunch of trades, is, well, what happens when the Dow Jones Industrial Average gets up to 26,500? That's what I am most, concerned about for the immediate, or what is on the immediate horizon. Because we've sort of broken down this market, all right, with the S&P 500 breaking out to new all-time highs. We've expected that to occur. We've also expected that to occur on the NASDAQ, which it has done. Today, we didn't close at a new all-time high. Yesterday being Wednesday, we did. All right, but at the same time, we've been talking about potentially that of a false breakout on these markets along with the Russell 2000 as the Dow Jones Industrial Average hits its resistance area and then potentially comes all the way back down to this upward, very nicely defined intermediate trend line. So that's definitely a possibility, a probability of actually occurring. A lot of people positioning themselves on the recent breakout on the S&P 500 and the NASDAQ, right? But we may see that of a reversal. However, I'm not expecting that reversal, if it does show up, to actually show up until the industrial average closes its gap, the final market, to close its gap all the way back in the month of January prior to the waterfall sell-off, very early on in the month of February. And then I'm going to gauge, right, the open positions that I have. That's how I am interpreting this market. I wanted to share it with you. It's a little bit foolish for me to sit down and to go through a bunch of these individual trades, right? We can start at Apple and make our way down the list. Again, it just comes down into really the inherent question, all right? Do you want to more or less take profit now? Or do you just want to let this sort of run potentially a little bit further as we see these markets over the next 1 to 2 weeks close those open windows, or the Dow Jones to actually close its, and then to have a look at what these positions are doing? I mean, not to open the chart in a week's time, but to actually gauge, well, it makes sense that we are at a logical pivot point, a turning point. Okay, so on Apple, we have that of a shooting star. It isn't technically a perfect shooting star, but it does resemble that of a shooting star. You can see this defined upper wick, but we do have a real white body candle to that candlestick. We closed up another $2.05, and again, it's a pretty decent trade. Entry at $219.61. We're trading at $225 already. If you're trading option contracts on Apple, you've already made a decent sum of money. So if you wanted to actually liquidate some or a portion of those trades, go for it. Do as you please. But please understand at the same time, for me personally, I'm looking at the Dow Jones Industrial Average. Although it's not relevant, okay, to some of these tech companies, I mean, obviously you should be trailing that of the NASDAQ composite a lot closer. The reason I'm using the Dow Jones Industrial Average is because it makes the most sense, okay, from a multi-market sort of standpoint, okay, or at least the intermarket relationship of this resistance area closing, okay, and some of the euphoria that we are seeing out there in the markets, okay. You've got Amazon. You should be out of this trade. 1,990 was the target. 2,000 is that psychological round number. We closed at $2,002. So I would be out of Amazon. You should be out of Amazon. Again, this position should be closed already. So you shouldn't be thinking about that open order on Amazon. You've got Boeing Airlines, which is still holding up at this resistance area. This is somewhat interesting to me because it does look as though we are going to get potentially that of a bearish reversal up around this 355 handle. If this has a white candlestick on Friday, well then this area of support below 345 is going to become that of a definitive area of support. And if we break that, I'm going to expect that of the Dow to ultimately have run up to that 26.5 area, and then to have set up the reversal, which makes a lot of sense, to take us back down to 320. This trade isn't ready yet, but if you're not in a trade, fair enough. I wouldn't be jumping into a trade on Friday. Baidu, you're still seeing this more or less hold up at that 213, 215 area. The reversal is set up, but this is the market noise, so to speak. We've closed that gap. This is looking like that of a bull flag continuation. And I think there is still a little bit of gas in the tank when it comes to some of these stocks rallying a little bit further. Again, what I'm going to be focusing on is the Dow, and that has really been our major focus, right? The arbitrage opportunity on the Dow. when compared against that of the S&P and the NASDAQ breaking out to new all-time highs. We've got Caterpillar continuing its choppy behavior. First entry 137.59, secondary 141.39. We've been warning about chop, and that's exactly what we're getting. However, the good news is that we are still holding up above this very much so strong primary bullish trend line. You can see here we tagged it 3 weeks ago, and what we haven't done is definitively broken down below 128.25. And as we're seeing this, yes, we are technically seeing that of, a short-term sell signal, or about to actually set up that of a short-term sell signal. What people are failing to see on that of Caterpillar is that divergence which formed off from the reversal, off from that trend line. So you see when we established that of a lower low with price action, but on the MACD we got a very steep reversal in terms of the momentum, or at least the lessening of momentum to the sell-off. That is a very bullish signal. So just because you're getting that of, potentially across on the short-term sort of minor level of the stochastics, it doesn't really mean all that much. We're still expecting this to come all the way back on up and close the open window. It's acting like a magnet. Remember all of the discussions that we have had on the Dow Jones Industrial Average? With the magnet pulling the markets higher, along with the NASDAQ, along with the S&P 500, consider that the same for Caterpillar unless we break down below that primary level of the trend, right, that I just screened out to you. We've got COP, no position in COP, another stock at resistance. We've got CVX largely moving sideways. Google today pulled on back down. This is a stock that's actually been rallying quite nicely off from our entry at 1,228. It still hasn't hit our target, and that's why I'm thinking still there is a little bit of juice left in this market to drive it on up a little bit higher anyway, prior to potentially seeing a rather abrupt reversal. But I don't think we are going to see that on Friday, nor do I think we're actually going to see this on Monday. So again, it's up to you what you choose to do. It makes sense if you want to bring up your stop. At the same time, the odds, all right, the probability of being stopped out goes up, but at the same time, at least you're locking in profit. It's completely a decision, of course, that you need to make for yourself. I'm just walking you through the analysis and what makes sense, okay? What makes sense at this time. You've got IBM also, which pulled back today. You can see on my screen, down $1.61. Very similar to the setup on Caterpillar. We do have a little bit of, if I can bring it up for you just here, a little bit of bullish divergence. Again, with this lower low, we've got the higher low with the MACD. If I wanted to draw it, I mean, pardon me for using my illustrating mouse here, but I'm trying to walk through it relatively quickly for you. But you can see, yes, we are close to getting sell signals, but these are largely deceptive at the moment. We've got a nice sort of chart pattern set up, and there's no reason to be concerned about this bearishly, unless really at this particular time we break 136. Expect all of this area, really from where we're currently trading at down to about 142, as low as 140 to be relatively strong support. And as long as the Dow remains healthy, as long as the S&P remains healthy, and what I mean by healthy is holding above that of the intermediate bullish trend line, you still have to remain relatively bullish on stocks, okay? If not aggressively bullish on stocks until we start to see, right, those structures break down, all right? And to conclude with, really, we've got two stocks left. Netflix was up today, $2.94. We've closed at a multi-week high once again. 328 was the original entry. Off from this pivot at about 330, we're expecting it to slow down and reverse. This was the old resistance turn new support. And of course, we've got the magnet pulling prices on up higher. So we still have, in my opinion, at least $22 to move to the upside. If not, probably more like $32 to actually close up, or at least re-tag $400 per share. But there is still part of me really that's looking at a lot of these stocks, recognizing a lot of these open windows, and it's making a lot of sense that when we get on up and when we close this, we could be setting up that of a deeper correction across the board for the US financial markets. But, and I must say but, it will not be that of a primary trend reversal, not at this particular point. I think we are getting close, but it's probably going to scare a lot of people. However, what's going to happen is it's going to be one of the very last times to, so to speak, buy the dip. All right, on sort of the intermediate and also primary level of this bull market, which I think is nearing its end within the next maybe 1, if not 2 years ultimately. Okay, but that is probably a discussion, or at least at a later date, where we're going to have to recognize that at the moment these markets are still technically sound, even though they are very much so overbought and rather exhausted, one could say, to the upside. Objectively, when you look at a lot of these oscillators and also momentum indicators as well, trend participation types of signals, and market breadth too, which is something that we're paying very close attention to, especially on the Russell 2000. I'm not going to go into the Russell 2000 today. that will be something that we talk about during tomorrow's class in Pro. Now, the final stock I wanted to speak about was Tesla. Tesla's all over the place. We have been largely staying away from Tesla, especially over the past, I would say for the month of August. We haven't gone anywhere near it. There was a trade actually below 321.40 that a lot of people took. It was a one-day trade. But when I see a very volatile type of stock, generally what we've seen over the past 1 week at least is something where I just completely navigate away from. And I believe it's rightly so. I do believe it is justified. Now, we are at, again, the psychological round number of $300 per share. Consider all of these tags, okay? Some form of a retest just to see whether or not that 300 handle can hold. And really, up until this point, it has. Yes, we've popped our head down below it on a multiple of occasions, but what we haven't actually done is closed below it and then actually continued below 300. If you start to see this area crack, okay, below the swing low of July, below the mid low in August, well then that opens up the door to a lot of our suspicions that we thought were going to happen in a more sort of protracted decline, more so back earlier in the month of 2000, or the year, calendar year anyway, of 2018, in February and also March, where we started to see a relatively quick, right, cracking of price action down to 240, but we stabilized very, very quickly. I don't think the dynamic of Tesla on the technical side and also the fundamental side has really changed all that much. I think it has continued, relatively speaking, or at least it's deteriorated more so, and I think it is sort of operating on limited time until we do see the definitive crack of about $290 per share. It's not something that I'm navigating around, so to speak, tomorrow during Friday's session, nor for Monday. This is more so going to be that of a type of timing trade, which is going to coincide with tech. It's going to coincide with the Dow when it hits its resistance area, and then potentially that fake to the upside and then a heavy reversal, which I think may potentially take a lot of people off guard. We've started to sort of work and navigate and flirt, you could say, with that idea. I think that idea and concept is strengthening. And I don't want you to be taken off guard, all right, when something like that, or if something like that were to happen. I want to take advantage of that, and I want to share that advantage with everyone who's willing to listen as well. But we're not ready yet. We're still trending nicely. We've still got an upper target to hit, but when we hit that target, we're going to take a rather neutral outlook, a short-term, potentially bearish outlook on the markets, right? A little bit of a contrarian perspective, but we are going to keep that very nicely sort of positioned when it comes to risk and reward on prospective trade opportunities. But at the same time, we're going to keep the door ajar to take advantage of the continuation of what may just be that of a parabolic sort of blowout rally and a trend continuation that continues indefinitely. And either way, it doesn't bother us. It's actually quite exciting. Either way, this market actually chooses to trade when we hit this resistance. But what you should remain is neutral. And to remain neutral as long as possible, especially when the markets are really not in uniformity. We're very close to uniformity, but we're not seeing, okay, transportationals at the moment confirming that of the industrials. We're not seeing the industrials confirming that of the S&P breakout and that of the NASDAQ breakout. So if you want to apply Dow theory, we're not actually seeing uniformity at the moment. All right, and that's generally a very strong signal when we do see it that the trend is a legitimate breakout. And until that happens, I'm working with some additional sort of, doorways or pathways that these markets may be setting up to actually position through and walk through moving forward. Okay. That's going to do us as at this Thursday. I hope that's helped everyone. It has gone a little bit longer than what I originally would have liked. My apologies for that. If you have any questions, email me, success@pivotpoint-trading.com. Until next time, and next time we'll be in that pro analysis class on Saturday. I wish you all very well, and I wish you a long weekend as well, a very nice long weekend. And please enjoy, of course, the extra day that you are getting on Monday away from the markets too. All right. It's James signing off on behalf of Pivot Point Trading. Thanks a lot for listening, everyone. Goodbye.